Hello guys and welcome back to another portfolio update where I go through my £55,000 plus stocks and shares ISA portfolio that I hold on Trading 212. This is made up of just 10 companies that are monopolies or have a particular competitive advantage in their field. All the focus on years of positive free cash flow that I expect to grow into the future. I'll cover the overall return of the portfolio in more recent times and any buys that I've been making, and then we'll go through each position, their weighting and overall return so far in this portfolio, with a few add-ons about what I think is cheap and valuations right now. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So it just feels like this is a very volatile time to be an investor. My portfolio's value has fluctuated more than it's ever done, and at the moment we're now starting to see a bit of a recovery just over the past week or so. But I have been down considerably from my highs back in February. If we look at the portfolio as of right now, we have an overall value of £55,400 or so, with a total return of £4,800 or 23% rate of return on Trading 212. With net deposits just over £50,000, and at the moment we're actually seeing a bit of a recovery on a very green day. And we can see that back in February on the 1st, this portfolio with £10,000 less in net contributions just a couple of months ago was actually up by about £15,000. So I hope you can appreciate that Trump's tariffs and the things he's been doing more recently has had a big impact on my portfolio as well as maybe yours. I've actually been contributing quite heavily to this account, with the ISA allowance going down dramatically for this year, using up about £9,700. We've actually got about 10k left to play with for this year before we can't contribute any more to this stocks and shares ISA. And we have about £1,000 in cash that's getting about a 4.6% rate of return through money market funds, and about £54,000 invested into individual stocks. And investing in individual stocks can cause some complications, some additional risks, and requires a lot more upkeep that I'm trying to stay on top of. Keeping hold of these 10 different investments is quite difficult, and it does mean that I have to be on the game. Additionally, it means that my returns may vary in comparison to the S&P 500. In a time horizon of about a year, we have actually outperformed the S&P 500 SPY at around about 11% return for this portfolio in comparison to SPY's percentage return of about 4%. What I've been trying to do through this volatile period is actually contribute money quite regularly to my account that I've kept on the sidelines, and then maybe contribute it to positions I believe will continue to outperform and larger conviction holdings that I want to invest more in. More recently, the portfolio is pretty much matching SPY's percentage change, and it is down for the year. Year to date, it's down about minus 9% in comparison to SPY, which is also down pretty much the same. So just like the market, I'm losing money so far this year, and it's actually a good thing in my mind. I'm using it to contribute more money this year, as we can see by using my ISA allowance. And that's gone mainly to two of my larger holdings plus a third really. I've tried to contribute evenly across my portfolio, but my weighting and percentage towards some of my larger holdings is getting bigger. First on that list we have Amazon, which is my largest holding at about 97 shares, around about £13,200, and we're pretty much flat on the position. This is mainly due to FX impact. As we can see here, my cost basis is actually below the share price itself. If we cycle down, we can see this impact a little bit more. We're down by about 4% because the dollar is actually weakening against the pound, and if I chose to sell out of this position, it would have to be converted back into pounds. But overall, this position is actually one that I am happy to contribute at these levels. I was actually buying closer to about $200 as well. So we have dollar cost averaged up a little bit and down a little bit in this particular holding. And to me, Amazon is actually presenting a very good opportunity at these levels. With it being down around about 21% in the past 3 months, we're actually seeing quite a good chance and opportunity with this stock, as certain metrics and fundamentals have continued to improve, but the share price has continued to deteriorate, especially over more recent times. One of my main metrics that I like to use for Amazon to see if it's offering good value right now is its price to operating cash flow, which currently sits around 15 times, which is historically a very good time to be buying Amazon. In fact, the last time it was sitting around these levels, it was around 2009 and 2010, just after the financial crisis. So right now, I think Amazon is offering good value to its relative possibilities for growth into the future. And that was all off tariff concerns with the likes of Trump. So I don't think there's necessarily going to be a free and easy ride for Amazon over the next, say, shorter period of next to a couple of years. But I do think that Amazon is a great long-term play, and I've invested a lot into this position. And just before I show that position sizing, I'd like to add that its free cash flow growth is year to date expected to grow by about 50%. So we could see a massive increase in free cash flow percentage in this next coming year and into 2026. And I think this is also factoring in high capital expenditure, which is obviously no guarantee and can be given up by Amazon whenever they choose to do so. Amazon sits at about 24% of this entire portfolio, and its weighting is only increased with my conviction in this holding. Moving on, we get to my second largest holding, which is Brookfield Corporation. Brookfield is another position that I'm actually down or pretty much flat on. I have 323 shares at an overall value of £12,600, and we're down by about £100 on that position, with a cost basis of about $50 compared to the current share price of $52. Again, FX impact is affecting this one in particular. But with this particular holding down about 13% in the past 3 months, I still think it's very good value, just like Amazon. And Brookfield is quite a complicated company. Without going into too much detail, they're an alternative asset management company that invests in lots of different companies, including insurance, Brookfield Asset Management, alternative asset management, where they manage funds, as well as the likes of energy and, of course, property infrastructure. And the main reason I like Brookfield is because it has an excellent management team behind Bruce Flatt, and, of course, their current valuation and metrics to growth. Right now, I work out that their price to distributable earnings, which is their key metric that they evaluate and use, almost like free cash flow, is sitting at 15 times. So using their market cap, I've worked out, divided it by their distributable earnings annualized, and we get to 15 times price to distributable earnings for this business. And all of this comes with a growth rate for the next 5 years that is very impressive. Over the next 5 years, Brookfield Corporation has put the guidance in of growing their distributable earnings before realizations at 17% CAGR, something they've done in the past and is actually fairly good guidance. After that, we can see a 25% CAGR in normal distributable earnings, which includes capital allocation and realized carried interest. These two metrics are hard to consistently value, so I don't tend to use those. However, if we look to the long term, this business is trading at 15 times price to distributable earnings and is currently expecting to grow those distributable earnings by 17 to 25%. And I think they can do it. Which is why I've been investing so heavily into this position. I've actually now got an allocation around 23%, which is rivaling Amazon in terms of its overall reach into my portfolio. And that's because I've got a lot of faith that this particular business will do very well, particularly in a tariff-intensive environment, because Canada and the way Brookfield operates tends to operate in the country of origin. Doesn't really trade across lines, and that can have a very good impact for their business, especially when relatively compared to the likes of Amazon, which may suffer. And then we come to my third largest position. This is a bit smaller than the other two, but still quite a heavy part of the portfolio at over 11%. And this is, of course, Google. Now, Google is one that I am still down on, and down more on than my other two positions. I have 54 shares, an overall value of £6,300, and we're down by about 6 to 7% on this position. Again, this is one that is impacted by FX and is showing to be particularly bad right now. Currently down by about 21% in the past 3 months, and with its overall return looking slightly better from this point. In terms of FX impact, we're down by about 4%, but overall gain and loss is looking a bit better at about minus 3%, with an average cost basis of $160 per share compared to a share price of $155 right now. And with it being down so much, I think Google is actually presenting a very good opportunity similar to Amazon, although I don't expect as good of a return if I'm completely honest. My main reasons are because their price to distributable earnings currently sits around 18 times and their price to operating cash flow sits around 14 times. This is well below their averages over the past 10 years, with their price to earnings looking particularly cheap with their EPS growth. All of which is involving a company that is growing its free cash flow very quickly. It is expecting to grow its free cash flow by about 17% over into 2026, which is a very impressive growth rate for a business that is in high capital expenditure right now, and I think just like Amazon could choose to devote less money to, at which point this free cash flow numbers and analyst estimates would probably go up. I've been contributing to this one as well as the portfolio's progressed, and I actually quite like its level sitting right here. It's lower than my cost basis, and generally speaking I think it has a good runway for growth. That's why it's probably my third largest holding, at around about 11%, and I'm happy with it sitting right there. I don't really want to necessarily make it a huge part of my portfolio, as I don't have as much conviction as it is for Amazon. Amazon is the number one in cloud, but Google is growing the fastest at the third biggest. And Google has great sort of initiatives that I think are going to continue to do well. And if they can continue to manipulate AI in a good way to use it with their search engine, I think that they will continue to beat out LLMs. So I quite like Google, I don't mind where it sits, and generally speaking I have high conviction this one will do well, even with its court proceedings and the likes of ChatGPT becoming competitors. So now we get on to my smaller holdings. These aren't as large as, say, the other positions, but are still substantial and have maybe been bigger in the portfolio more previously, just like this particular holding. I have Visa, which is a great credit payment processing company, and this one is just amazing for compounded growth and really for shareholder value. I have 20 shares at an overall value of saying £5,000 and we're up by about 20% on the position. We are cost basis sitting around about $263 per share and overall share price currently of $336 per share. FX has affected this one as well, sitting down about 5%, but that's obviously if we sell it now, and I don't plan on doing so with the likes of Visa. Visa is just an amazing company that I really like to invest in. I was investing in this one heavily when it was a little bit lower, and I really liked its future potential growth and its general outlook for shareholders. I really like that they do consistent share buybacks, which are really predictable. The business model is highly predictable and offers good growth still, even with them being the largest competitor and monopoly in their field. And then obviously it gives basis to more things like dividend growth and of course in terms of just free cash flow per share growth. So I really like Visa's business model, predictability and its future runways, even with it maybe offering less of a return than some of my other holdings. And Visa has actually done a lot better than say Amazon, Brookfield and of course Google, because I think people are less concerned about Visa. The ones that hold this particular holding aren't likely to sell just based off random tariffs, even though it may affect the business. Visa now makes up around 9% of this portfolio. That was down from where it sat above Google at around 12 to 13%. And this was because I actually trimmed this position to buy into some other holdings. And I'll be talking about them shortly. But I still believe Visa is a great holding. I expect it to return around about a 13% CAGR over the next 5 years and is one of my more defensive names. The next company is one that is more cyclical in nature than say Visa, and it is in the semiconductor industry. This company I think offers amazing moat that is very unchallengeable, has next to no competitors and is probably one of the strongest moats in my portfolio. Now, right now, this Dutch company, which is ASML, is offering a good level to buy at, in my opinion. I have around 8 shares at an overall value of £3,900, up by about £400 in this particular portfolio, although I did invest in my invest account in this one when I sold out of it, which was at a higher cost basis. So actually our returns for this one are not quite as good as they first appear. When you dive into ASML and you start searching about its competitive advantages, who they sell to, the likes of Taiwan Semi Manufacturing, Samsung and Intel, and you see how the partnerships have developed over the years and how ASML has continued to stay ahead of the game and ahead of its competitors, you really see how amazing this business is. And it's currently trading for really good valuations with very strong possible earnings per share growth in the coming year or so. So I really like this one for the future. Now, another company that is an excellent monopoly and one that I've been trying to increase my allocation to and the exposure of the portfolio to is the like of S&P Global. This is an amazing credit ratings and intelligence and market intelligence business that I think is offering a good level with free cash flow yield right now. At the moment it's 11 shares at an overall value of £3,900 and overall return sits at about 5% or £200. This is a position that more recently hasn't struggled as much as my other holdings, around about down 6% for the past 3 months. We can see that FX impact has affected this one as well. We're down by about 5% if we converted this one back into pounds right now. And our cost basis sits at around about $426 with an overall share price at the moment of $475. I've been trying to increase my allocation to S&P Global for a while, and I saw a good level more recently. I think it was presenting very low, and I saw that Visa, in terms of its predictable nature, was very similar to S&P Global. However, I could see the potential returns for S&P Global being better than the likes of Visa at these current levels. And that's just because of valuation and percentage for growth into the future. Both operate very predictable business models. They're more defensive financial companies, and I wanted to have a good allocation to that in my portfolio. So I actually trimmed a little bit of Visa and put it into S&P Global, which puts its allocation very similar to ASML at about 7% of the portfolio. And it's one that I hope to grow to around 10% into the future. We get on to more of a growth-based investment that is still a monopoly in another area of the world. And that is, of course, Mercado Libre. And I have around 2 shares, around about £3,273, up by about 24%, with a cost basis that actually sits around about $1,684, compared to the share price of $180. And this is impacted by FX impact, maybe not as much as the others, and is an amazing holding that I am very happy to hold for the long term. Mercado Libre, if people don't really know, is a e-commerce and fintech business that is doing very well in Latin America and has performed quite well more recently, massively increasing my portfolio value compared to other positions. In the past 3 months, it's up by about 18%, when other positions that are bigger in the portfolio, like Amazon, are down over 20%. Now, Melly may not be the largest position in my portfolio, around about 6% of the overall portfolio, but it's one I have high conviction in. My main reason to maybe not diversify too much into this one is because of where it operates in the world. It's an amazing monopoly in the fintech business that is growing rapidly and is highly margined in that area of the business. It's a bit similar to Amazon in their business and pretty much shamelessly copies Amazon in terms of its overall sort of contributions. It essentially gathers people into a ecosystem through e-commerce and then tries to get them to use other products like their fintech side of the business as well as other areas that they operate in. And Melly is one that I am very happy to see is growing very well and is actually holding out a lot better than the overall market and other positions in my portfolio because it's pretty much holding up my portfolio. Now, in terms of its future growth, its free cash flow is expected to grow over 20% over the next 20 years. Sorry, 20 years, 5 years. Now, in terms of its growth, Melly is offering around about a 20% CAGR over the next, say, 5 years easily, in my opinion. And that's mainly because as long as they can produce the same results that they've been doing, which I see no reason to say why they can't, I think they do very well, especially in a high tariffed environment, because America isn't really a massive contributor to their revenues. They don't even really sell in America. So actually, all over the world, people may try to use Melly rather than, say, Amazon, because those tariffs will apply. And that's probably why this one is up around 18% when the market is down over 12%. So I actually quite like this business overall. Now we get on to another defensive name, one that I quite like as another source of maybe dependency in the financial sector, although this one's obviously an alternative asset management. And I already have mentioned their parent business, and that is, of course, Brookfield Asset Management. Now, some may say this is a bit of a strange one, but I have around 71 shares at overall value of £2,700, and we're up by about 11% on the position. FX impact has affected this one a little bit, down around about 4 to 5%. And overall, our cost per share is sitting at $43 per share, with an overall share price right now of, say, $51 per share. Now, obviously, Brookfield Asset Management is maybe a stranger one to have, because if you're familiar with Brookfield Corporation, then Brookfield Asset Management is essentially a part of that business. They own 75% of this business and reap the rewards of their cash flows. But this is a business that I think investors can understand a lot better than Brookfield. Brookfield is a very complicated business. They have to use metrics like distributable earnings to essentially explain their free cash flows to investors, and lots of people will choose not to invest in these types of businesses. However, Brookfield Asset Management is slightly different. People will choose to invest in the likes of Brookfield Asset Management over Brookfield Corporation because of the dependency and reliability of these free cash flows, with a highly margined business that is better than the likes of Visa and MasterCard. Predictability is also followed by the likes of their possible future growth. They're expecting around 18% distributable earnings before realisation growth over the next 5 years, which is contributing to Brookfield Corporation's numbers and future growth. Now, I do think that Brookfield Corporation is offering better value right now, but I do think the investors will be more likely to invest in Brookfield Asset Management because of its high margins, and will actually apply a higher premium to this business over the longer term for its predictability. But we'll have to see with that one. Its allocation now sits at about 5% of the portfolio, and this is again one that I used trimmings from the likes of Visa to do. And this position is the newest in this portfolio. Get on to my smaller positions, and ones that I quite like as smaller holdings, say them below 5%. One of which is probably one of the companies I've held for the longest, which is Texas Roadhouse. And the reason to hold it, with 18 shares, around about £2,200, an overall increase in value of 31% or £535, is because this business is actually performing very well and is holding up very well against other positions in my portfolio. As of right now, in the last 3 months, it's down by about 9%, pretty much matching the market, but up considerably compared to some of my other holdings like Amazon and Brookfield. And I think that this is one that I don't really feel a need to continue to contribute because my cost basis is so low. It's down to $118 per share, even though I was contributing around this $90 mark. And its current share price is sitting at $164 per share, down from its highs back in 2024 in November, where it was sitting at over $200 per share. Texas Roadhouse is one of the only businesses that I have that is solely based pretty much in the US. And this business is very small by comparison to some others. Its market cap is just over 10 billion. And Texas Roadhouse is around about a 4% position in my portfolio. The reason to continue to have it is because I see its great runway for growth. They're continuing to open up restaurants solely in the US. They don't need to worry about international or economic concerns, even though the tariffs will affect them through the produce that they actually need to make their food and stuff. Their restaurants are continuing to do very well with their earnings and earnings per share growth continuing to do very well into the future. So I really like this one for its domestic growth lines, you could say, and it's just predictable restaurant business growth. I like some exposure to this area, as I do believe that consumers are really quite happy to pay up for quality food. And Texas Roadhouse provides that. I've actually visited there a couple of times in America. So I really like this business. I've got a small allocation to it, and I don't really plan on adding to it at these levels because I think there are other areas to invest my money that offer better returns right now. Then we get on to my smallest position, my roller coaster of a stock, one that I really like for its growth potential into the future, but don't necessarily like for its volatility. We have, of course, Hims and Hers, which I have 51 shares of at an overall value of £1,000. And we're down by about 5% on this position. Now, this is crazy to me because this position was actually up considerably just around about February 2025. If we look back to that period, we can see here that it was sitting around about $60 per share, and I was up by around about 160%, if not more, on this position. And I just think that that is quite funny that it's returned back to the levels that I was buying at. I don't really mind. I know that some people may say, well, you've missed out on potentially 160% return on this stock. Yeah, you're true, you're right. But the way I was valuing it, the way I was looking at its free cash flow growth, it could have happily sat at those levels and just traded flat for close to a year. Its annual free cash flow growth has been amazing. It's grown nearly 90%, I believe, over year in its free cash flow. And I can see its subscriber growth, its free cash flow and operating growth as very predictable, despite it being such a volatile stock. So I actually quite like a small allocation to this one, and it sits around about 2% of my overall portfolio. I think I'll keep it at that level unless it goes down as really low levels, and I may have to have a look at it again, even though I think it's offering good value right now. There we go, guys. That is my entire portfolio. In terms of positions that I think are offering maybe future returns that are going to outperform the market right now, I think Amazon and Brookfield are both companies that I'd happily contribute to at these levels, followed closely by Google and ASML. The likes of other businesses may offer future outperformance if they were sitting at different levels. The likes of Visa, I think, is fairly too overvalued right now given the market performance. I think there's better places for positions to be adding to. And S&P Global is one that I think trades at fair value and maybe could continue to be allocated to at better points. Mercado Libre, I think, is still undervalued. And Brookfield Asset Management, I think, is an individual play that I wouldn't necessarily recommend to anyone else, but one that I actually wanted diversification towards over the likes of Visa. Hims and Hers is a roller coaster ride, but I do think this one offers great future growth rates, followed by Mercado Libre in terms of potential outperformance and growth overall. But that's it, guys. I hope you enjoyed this video. If you did, please leave a like, as it does help me out, and feel free to comment down below if you like this portfolio, what you'd like to see more of in future videos. Thanks for watching, I appreciate it, and I'll see you in the next one.